Fire away.
Well, welcome to our weekly High Rock video. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. We're going to chat about what we see happening in the global economy and financial markets and the world of wealth management and how we are adjusting our investing strategy accordingly. We do have a website for first-time listeners. If you want to tune in to www.highrockcapital.ca, please feel free. We update from time to time, so even our regular clients, if you have a peek at the website from time to time, help yourself.
And
Paul?
we should probably add that we do write blogs pretty regularly, and we talk a lot about what our thoughts are in the overall markets in the blogs as well.
Well, markets and other aspects of wealth management. Very specifically, recently, I think we've had a bit of a bed bug about fees and some of the fees we see being charged out there.
That's right.
And I think one of the important things that we do at High Rock is try to not only be transparent with our fees, but keep them as low as we possibly can.
Yeah, and we have ways of doing that.
Absolutely.
So you said models.
So models. Let's talk about
we didn't make a lot of changes this week, last week. One thing we did do, and again, just to build on some of our outlook in Canada and specifically in Canadian hydrocarbons, we did fully eliminate and sell out of a position in an oil field service company in Canada. And quite frankly, it didn't really work out well. Now, some newer clients that got into the specific stock, almost had a double, because I was able to get them in somewhere in the 65-70 cent range, and we ended up selling it around $1.25. That worked out well for some clients, but anyway, overall, it just did not work, and I think our view is to remain out of this one. I think they're going to issue equity very shortly in the next couple months. So that was really the only change we actually made in our portfolios across the past week.
And I don't think we've changed our outlook on our global equity. We still think that equity markets in general are expensive, and we'll talk about that in a second.
Yeah.
But as far as fixed income are concerned, we are seeing a little bit higher yields in some of the longer dated bond structures.
All bonds. Actually, yeah. Certainly as of this morning, the entire curve is higher in yield, lower in price.
But the curve continues to...
it's got still a little bit of flattening to it.
Still flattening, right?
Yeah.
Okay.
And then the other thing we noticed, and we said we would talk about, are high-yield bond spreads. Now, high-yield bonds typically trade with a zero correlation to government bonds or interest rates. But we do follow the spread, and as you can see in the chart above, that is the Canadian dollar high-yield bond market in a spread to the government bonds. So all sort of corporate credit bonds trade with a spread above government bonds because you're taking incremental credit risk to get that higher yield. Anyway.
And just for clarification, a government bond, a Canada government bond, is rated AAA.
Yeah, and considered the safest.
And then it's tiered down as you get to lower ratings, double B, single B. That's when you start to enter into the high yield.
Double B plus and lower into single Bs, as Scott said, and even into triple Cs and double Cs are all considered high yield. But as you can see from that chart, the spread to government bonds is actually rallied in a fair bit and compressed, and that means the price of these high yield bonds has gone up. So high yield bonds in our portfolio, our client portfolios, have done quite well, as you can see from that spread compression. And same in the U.S. Their spreads have compressed, and the chart looks pretty much the same. The question becomes, when do these spreads start weakening or widening out to government bonds? And I think the answer to that will be not until there's a real serious issue. But don't forget, bonds lead. So these corporate bonds will lead equities. So that's why we're showing this. We're going to keep a very close, watchful eye on credit spreads.
And to a large degree, the great thing about high yield is that they're not necessarily correlated to what's going on in the world of interest rates.
Zero.
So if interest rates are rising for government and investment grade bonds, it's not necessarily the case for corporate or for high yield bonds.
As you can see, they've done very well the past year, and yet interest rates, government bonds have gone, yields have gone higher.
Right.
And government bonds have not performed all that well on a total return basis. Total return in high yield has done very well.
And what we're trying to do to a large degree for our clients is be in securities and investments that are not necessarily correlated to other things. And we know that from historical experience, when things go awry, things that are correlated tend to all move in the same direction.
Right.
And what we want to achieve is that non-correlation as best as we possibly can, because that helps to lower our risk factors. Right?
Yeah, and we do run correlation models on all these sort of asset classes through an Excel file. So, I mean, there is some method to the madness here. We're not just throwing something at a wall.
Well, let's talk about. There's been a lot of talk about global economic growth and how it has picked up. And this chart in front of you gives you an idea of what's been going on in the G7 specifically. And we do see some interesting developments. Canada, of course, has had the best record of growth for the GDP for GDP for the G7. But as you've been telling us for quite some time now, the weakest stock market growth.
Yeah, it is ironic, isn't it? I mean, and most of our growth in or performance in the Canadian stock market came really in October and November. 2 months of the year, we were down at the end of August. Our stock market was the only stock market in the G20 or developed world that was negative year to date in 2017. And then it punched up pretty strongly. We had a couple of really good months. And as you can see, we were up 9.1% on a year-to-date basis, 2017, total return basis. But still, the worst performing stock market, basically in the G20, and the highest GDP growth. Something doesn't jive. And I think I know what it is.
Bonds lead, but stocks are also usually pricing in ahead of economic growth.
Yes.
So anxiously awaiting, and we saw fourth quarter U.S. GDP growth last week was a little under what was anticipated. So they're expecting somewhere 2.93, it came in at 2.6. But again, it's last year's news now.
Yeah.
We have to start looking forward, and looking forward, we're looking for signals and signs from economic data.
Right.
And that GDP growth in the U.S. Is coming. We know the U.S. Federal Reserve is meeting tomorrow, and it's 2 days, so Tuesday, Wednesday, and we know that the probability of them raising rates tomorrow is low, but we do know that they're expected to raise rates. Or there's a 75% probability that they will raise rates in their next meeting
in March.
Mid-March.
Yeah.
Right at spring turns.
And maybe one of the reasons why they don't need to raise rates so highly quickly is because of the U.S. dollar. The U.S. dollar, as you can see, has been coming off pretty substantially, and that has an effect of providing monetary easing into the U.S. economy. Effectively, without getting into more detail, is exporters get to export more when the U.S. dollar is cheap. So that's an effect that may slow the pace of Fed hikes down.
And last week at the Davos meetings, the Treasury Secretary Mnuchin said that he wasn't unhappy with where the currency was going, and is that some way a bit of an insight into what they're thinking as far as it's better for export growth for the U.S. if we can talk our dollar down a little bit.
Yeah, and I think that's what they're doing, is talking it down.
And is that, in essence, some kind of initial trade war beginning? Is this something that we're...
it is odd, though, that the U.S. Central Bank, the Fed, is probably raising rates at a faster pace than anyone else, yet the dollar is getting hammered. It should actually be going up.
And also, their core CPI, or not CPI, core PCE price index
Right.
which is what they target, is well below target. And that,
Though it's popped up a little bit.
it's popped up a little bit, but it's
lately.
still well below target.
Yeah. Oh,
And raising interest rates without that inflationary scenario is interesting.
Now we have a lot of data this week,
Yes, we do,
so we'll be
including U.S. employment data
on Friday.
Yeah, Eurozone GDP.
There's a ton.
Another some Japanese data, Chinese manufacturing, things like that. So lots of things for us to be watching. As you all know, we monitor all of this very closely, trying to make sure that we are adjusting our risk-taking situation accordingly. We always keep our clients' longer-term goals in mind when we're doing this for their portfolios, but it is something that we're constantly monitoring. And with that, we'll draw it as a conclusion to the weekly video, and wish everybody a great rest of the week. And we'll be back next week with another version.
Good week.